back with first trades right here on ET Now. It started off on a weak note. That is how we're trading this Friday after a quiet session yesterday. Navneet Munot, CIO at SBI Mutual Fund Management. Nikun spoke with him earlier on and he shares with us his investment strategy and his views on investing in companies with healthy balance sheets and a strong asset case. He is, of course, bullish on pharma, IT as well as private sector banks.
One sector where we have been bullish for last couple of years and that has paid off very well for our funds is pharmaceuticals. But if you look at the earnings growth, I mean in the last every quarter, I mean they have been delivering on expectations and in fact exceeding expectations in several cases. Similarly for the consumer names, I mean several of them have actually delivered in terms of numbers. Also for IT, but as I mentioned that you have to look at stock specific rather than a pure sectoral call. There are companies that have been delivering and market is kind of rewarding them more relative to the ones who are not delivering the numbers. That's what I said that this time it's much more I would say a smart rally in that sense.
But in terms of a very basic portfolio strategy, are you hiding in defensives or it's time to revisit beta and time to throw in some amount of growth?
See, our portfolios throughout 2011, given the macro environment, we were very bearish on the global macro environment. We were bearish on the domestic macro environment. We had concern just like everybody else on the whole policy side. Also, I mean, in terms of the overall corporate balance sheet, the way it has deteriorated in a part of the corporate India. So we were worried about all those factors and we were extremely defensive. The mantra in 2011 and early 2012 was stay with quality. Valuations don't matter as much. So I mean, even if you have to pay a premium for buying a quality, it's better rather than looking at the valuation that this has turned cheaper in terms of valuation and let's look at that, because stay with the quality in an extremely uncertain, volatile, deteriorating macro environment. But as I mentioned that last few months we realized that probably things can, at the margin, things can improve and you completely can't ignore valuation. So I'm not saying that we have substantially gone down in terms of quality curve. And by the way, when I say quality, it's like the strength of balance sheet, it is the business prospects, it's visibility of cash flow, and then some of those things. And people who meet these parameters, I mean, we didn't really mind paying excessive premium. But we have churned our portfolios over the last few months. So for example, a couple of names in the consumer space, which were some of the larger holdings in the portfolios, they are not as large a holding today. And we have incrementally moved into some of the cyclicals, rate sensitives, financials and all, where we found that on a relative basis, valuations have turned attractive.
Every market, the courses remain the same, but horses they change. So whenever the cycle will reverse, which are the new horses you are betting on?
We are far more stock specific and we think that there's going to be consolidation or there's going to be transformation across sectors.
So it's not a top-down approach?
It's not a very strong top-down call that we have. As I mentioned, there are few top-down calls. We have been extremely bearish on materials, particularly the metals, not the cement, but particularly metals. That's driven by our global macro view, particularly the slowdown in China, which is coming true, and it has impacted most of the companies, so that has paid off. IT again is a mixed view. The rupee, so some of the macro calls I'm telling you. So the rupee depreciation has helped the pharmaceuticals and the IT sector, and that's why it has helped some of those sectors. The rate sensitive, as I said, that within the financial space, we have been overweight on the private sector banks, and we have been underweight on PSU banks. We have concerns on the asset quality in that space.
Underweight PSU banks coming from SBI, that's a rarity, isn't it?
Yeah, but we are seeing the numbers. I mean that the private sector banks, which are more driven by the retail franchise, they have delivered better numbers, and for several reasons, whether the SME space or the infrastructure space or the agri space, because of several reasons, PSU banks, I mean in terms of the sheer numbers that you look at, whether the profitability or in terms of the asset quality, private sector banks have done well, and that call has done very well for us.
So where is deep value in this market? Is there deep value in infra stocks which are available at a single digit P multiple? Is there deep value in PSU banks now which are approaching price to book? Or there is deep value in metals which are now available below replacement cost?
One of the macro view that we have got is that anybody who owns good quality asset in India as of now is going to be very valuable few years down the line, for the simple reason that if we talk about the policy paralysis today, if we talk about is very difficult in getting the environmental clearances, acquiring the land, getting lots of state clearances, and the whole, the rupee has depreciated 20%, interest rates are very high. Putting up a new project today is going to be very, very challenging, and corporates don't have the confidence. Anybody who's got the asset today with the nominal GDP growth that we have in the next cycle, they would be at a huge advantage. But as you mentioned that in infra space, there are few players, but the problem is that everybody has got a specific issue. So you can't look at a company and then you find that there's a great airport asset, but he's got some investments in Australia which you don't like. Or somebody has got a great port, but he's got other investments which you don't like. But you have to find few of the gems within them. Maybe I think cement could be an example, or let's say there could be power assets which have got a good coal linkage, and probably a good quality asset which is working today. I think some of these are going to be very, very valuable.
The call which has worked for you like a charm has been your overt exposure to consumer, and especially in pharma names. Are you still hot on pharma? Because if I look at pharma stocks, at least the Indian pharma companies, keep the MNC on the side, aren't they priced to perfection?
See, we don't own too much of MNC names because of some concerns on the pricing policy in India, and probably there is some regulatory uncertainty there. But the overall pharma, look at all the cylinders. I mean, you look at the US growth, it's been above expectations, or also the next 2 years are the patent cliff, and then you can expect good numbers. The larger companies growing at 20-25, some of the mid-cap names growing at 40-50%, of course on a smaller base. The domestic growth at 14-15% is like very much sustainable, given our extremely low penetration of the overall healthcare. I think there is a fair amount of visibility on that front. And also their investments in the emerging markets, which are likely to pay off as and when the growth kind of peters out. I mean, on the US side, you can have the new growth driver coming in from the emerging markets. So the whole generics space is something, and the domestic formulations is that we like, and we own stocks across large and mid cap. And again, it's more stock specific. So I mean, look at the market, you take few macro calls, you look at valuation in some places, but there are very few great businesses to buy, and particularly in that $1 billion to $5 billion market cap types, which can actually become 10 or 15. And actually in pharmaceuticals, you find some of those names of companies which are like few $100 million today, but they can become $2-3 billion companies in 3 to 5 years time. So you find some of those names which fit your whole philosophy of to look at a business. And also the rupee depreciation has kind of helped them. So 20% rupee depreciation for this particular sector, which has got some pricing power, has really helped them. So the only thing is that the sector could be overowned. It's been a flavor for last couple of years, and probably overowned in the institutional space. But unless you think that market can rally substantially, driven by some of the other cyclicals, till such time the visibility that you have on these companies, I think gives you a lot of comfort.
What about FMCG? Many would say that FMCG stocks are priced to perfection. Look at the P multiple for HUL, look at the P multiple of Nestle, wild P multiples.
So several of them, I mean, I won't take the individual names, but we have trimmed our holdings. So we don't own too much of staples. I think substantially lower than the index weight. But there are some of the discretionary, and as I keep saying, I mean, that's a structural story. That's a J curve which is playing, and a confluence of factors which is giving the not only the resilience in the consumption, but there are categories which can grow at a high multiple, very clean balance sheet. I mean, the ability to keep increasing your ROE as the top line keeps growing, and you reinvest that at a higher rate, or companies that have got high dividend payouts, so they don't need too much of capital, the comfort that you get on those businesses. Those are the companies that we own within that space. But overall consumer, we may have become underweight now. I think we have shifted our portfolios a little bit in favor of more cyclical.
You also have a big exposure to niche FMCG names or niche consumer names. Now the world called it expensive in 2010 when you were buying Jubilant Foods or Bata or Reddington, and those stocks have really created a lot of shareholder value. Are you still bullish on niche consumption, because that is again a function of how Indian demand is moving?
But I mean, we always keep a fair watch in terms of the valuation versus the expectations. So our expectations of growth and in terms of what we are paying. So some of the names where we found that valuations have got a little stressed, we have trimmed down. some of these are like very structural stories that for next couple of years they can continue to probably deliver high amount of growth with huge capital efficiency, and you also have the confidence. I think the mistake in India most of the promoters make are on capital allocation, and our comfort on those companies, and I spoke about the pharma, is that in terms of capital allocation they have been more disciplined. So that discipline, I mean, you have to pay some price for it, because I mean we have seen that indiscipline is the one which have really destroyed lots of businesses and companies, and some of these guys who don't make that mistake, and that's something that we always keep a very close watch, and then we are willing to pay a little bit of premium, because those promoters, I mean, over a longer period will continue to generate value for you.
The fact that your schemes are in the top quartile, and they have been in the top quartile, my compliments first, and my question is, that is because you've differentiated. So how are you planning to differentiate from your peers?
So couple of examples that I give, let's say on the banking space, a big call on private sector banks versus the PSU banks, because we thought that asset quality could surprise on the downside. Even in the IT, I mean, I won't take the individual names, but they are like very, obvious
names.
In terms of our stock selections, our bottom of the stock selection, the kind of processes that we have put in place, I think that's done very well for across all our funds, rather than extreme amount of large macro calls and then probably trying to get that right.
So if you're bullish on IT, which you are, if you're bullish on pharma, are you bearish on rupee?
No, I'm not bearish on rupee, but I think that 20% depreciation has happened, almost 20%, and I'm not expecting a severe appreciation of the rupee. Having said that, as I mentioned, that I don't belong to the camp which says that it can go to 60 or 70. I think probably flows will continue on the equity side. In fact, I expect some measures from the government, let's say something like a reduction in withholding tax on the debt flows that can actually increase the flows on the debt side. I think probably the overall trade in terms of, the going short on emerging market currencies, probably that can kind of, recede. So going forward, I'm not very bearish on rupee, but the depreciation has been, I think, enough for some of these companies. And it's not purely driven by the depreciation. Ultimately, your buyer, so for example, in IT, ultimately it will get priced out. So I mean, you can't really sit on that and then for a long time you can make money.